Time now for Better Money with Joel Johnson. Today we're talking about 4 overlooked tax breaks for retirees. Joel is a certified financial planner and managing partner at Johnson Brunetti. If people haven't filed yet, this is a good one to keep note of.
Yeah, and most people haven't filed because they're just in the process. You know, the financial firms don't have to get you your stuff as early as they had to. So most people are right in the midst of thinking about filing, and you should be really paying attention to the tax break, especially as a retiree.
Yeah, so there's 4 that are overlooked. And number 1, you say at age 65, you get a bigger standard deduction on your taxes.
That's right. So unless your income is very, very big, everybody gets this standard deduction, and it's $1,550 more once you're age 65. So that's good news for retirees. And if people are doing their taxes by themselves, they might not know that. They might fill in the wrong amount, especially if you're just Googling what is my standard deduction and so on. So it's important that you take advantage of all these deductions.
Okay. In 2016, taxpayers 65 and older can get a break on deducting medical expenses.
That's correct. So the floor is lower. What I mean by the floor is there's a certain amount of medical expenses we cannot deduct. But then once you get to a certain percentage of your income, you get to deduct those medical expenses you had to pay out of pocket. Before you're 65, you have a threshold of 10%. You've got to spend 10% of your income on medical before you get any deductions. Once you're 65, that drops to 7.5%.
Okay.
So there's a lower floor. You start getting deductions earlier, and it's important people know that and gather up all their medical bills and so on, especially nowadays when we have to pay things out of pocket more than we used to. Right.
Okay. And this is also for number 3, your spousal IRA contributions can apply if you're married and your spouse is still working. There's a $6,500 limit for the traditional IRA. So this might sound confusing. People, explain this part to me.
So what this means is that everybody is able to contribute to an IRA if they have earned income.
Yep.
But even if I don't have earned income, if my wife Wendy has earned income, she can contribute and I can contribute. We can both contribute.
Oh, okay.
So people say, well, gee, I'm not working, I can't contribute. That's not necessarily true. If your spouse is working, you both may be able to contribute and get a little more money into a retirement account and get a tax deduction for it.
Okay. And what's the pension payout trap?
So this is interesting. Many companies now, Kara, if people are entitled to a pension, companies are trying to buy that out. They're trying to offer people a lump sum instead of having people take the monthly pension. Well, if you don't handle that lump sum properly, if you just get a check and plan to roll it over into an IRA, they're going to withhold 20%. Now you've got to write a check to make up for that 20%. Otherwise, the 20% they withheld gets coded as a distribution. Little confusing, but the bottom line is it's really bad unless you roll that money over properly. Most people should take a lump sum from their pension, but if you don't roll it over properly, you're going to have a huge tax hit, and you may lose the ability to use that money in retirement in the future.
Okay, so you need to, when you're rolling it over, talk to your financial advisor. Make sure it's just done right so you don't have to pay the taxes.
Exactly. It never hurts the older you get, and the more money you have to at least get some outside advice from a certified financial planner or a CPA on all these tax and financial issues.
And you can get some advice, free advice, by emailing Joel and his team at bettermoney@wfsb.com. I know you'll take anyone's questions.
We love to get the emails. We get so many every week, and I love answering them, and we meet a lot of great people through that email, and they get some good advice.
Thanks, Joel. That's Better Money.